What if I told you that while you were celebrating New Year's Eve, clinking champagne glasses and watching fireworks light up the sky, the entire global financial system was quietly bleeding to death from a wound it cannot stitch closed? And here is the terrifying part. The people who actually run your money, the hedge fund titans, the chief investment officers, the institutional risk managers who control trillions of dollars, they were not even at their desks to see it happen. They left the junior traders and automated algorithms in charge. And now, as they walk back into their offices on this cold Friday morning, January 2nd, 2026, they are not walking into a normal trading day. They are walking into a crime scene. And the murder weapon is the one metal nobody was paying attention to: silver. Now, before I reveal exactly what happened and why the next 72 hours will determine whether you become wealthy or whether the system swallows you whole, you need to understand something that the mainstream financial media will never tell you. What you're about to hear is not speculation. This is documented. This is verified. And this is happening right now as you listen to my voice. Let me take you back exactly 1 week. It is Friday, December 26th. The Christmas turkey has been eaten. The presents have been unwrapped. Most of America is still in a food coma, scrolling through their phones, completely unaware that something catastrophic is unfolding in the shadows of the financial system. The Federal Reserve's overnight repo facility, which is essentially a pawn shop for desperate banks that need emergency cash to survive the night, suddenly explodes with activity. $17.251 billion appears out of nowhere. Let that number sink in for a moment. $17.2 billion on a holiday Friday, when the markets are supposed to be dead quiet. Now here is what makes this absolutely terrifying. Healthy banks do not touch this facility. Healthy banks do not run to the Federal Reserve on a holiday weekend begging for emergency cash. The only banks that use the overnight repo window are banks that are about to collapse. So the obvious question is, what happened that forced the biggest financial institutions on the planet to suddenly need $17 billion in emergency funding within hours? The answer will make your blood run cold. Silver. Silver happened. On that same night, while America slept, silver gapped to $77 per ounce in international markets. And when I say gapped, I mean the price teleported. It did not climb gradually. It jumped through what traders call an air pocket, a price zone where there are literally zero sellers. Nobody was willing to part with their physical silver at any price below $77, and this triggered the largest margin call in the entire history of the commodities market. You see, for decades, the biggest banks in the world have been betting that silver would stay cheap. They built massive short positions, hundreds of millions of ounces worth, at prices like $30 and $50 per ounce. These are bets that silver would go down, but when silver suddenly rockets upward, those bets become catastrophic losses. The banks' internal risk models, the same sophisticated algorithms that are supposed to protect them, simply exploded. Red lights everywhere, margin call alerts screaming. And the clearinghouse, the institution that guarantees all trades, was about to forcibly liquidate these banks' positions. Do you understand what that would have meant? If the clearinghouse had liquidated those short positions, they would have been forced to buy hundreds of millions of ounces of silver in a market where nobody is selling. Silver would have hit $200 in a single tick. The entire banking system would have cratered before the sun came up on December 27th. So the Federal Reserve did what it always does. It printed money, $17.2 billion, created out of thin air, injected directly into the banking system as a tourniquet to stop the bleeding. But here is where the story takes a darker turn. And this is the part that the returning A-team of institutional managers is staring at right now with absolute horror in their eyes. The Federal Reserve can print infinite dollars. They can conjure up 17 billion or 17 trillion with a few keystrokes. But there is one thing the Federal Reserve cannot print. Not one single ounce of physical silver. And by bailing out the shorts, the Fed has accidentally created a doom loop that it cannot escape from. More dollars in the system means the currency loses value. When the currency loses value, hard assets like silver become more valuable. When silver becomes more valuable, the short positions require even larger margin calls, which requires the Fed to print even more dollars, which devalues the currency further, which makes silver more valuable. Do you see the trap they have built for themselves? The $17 billion was not a solution. It was the opening bet in a game they have already lost. And the game has just entered what I call the unobtainium phase. But wait, because what happened next makes this situation exponentially worse. And I mean that literally. Yesterday was January 1st, 2026. While the Western world was nursing hangovers and watching college football, China made a move that will be remembered in history books for centuries. A leaked document from the Ministry of Commerce in Beijing has confirmed that China has implemented the most aggressive resource nationalism policy in modern history. As of yesterday, any silver leaving Chinese borders requires what they call a strategic necessity waiver. This is essentially a special permit that must be approved by the highest levels of the Chinese government. And here is the devastating detail. For the entire first quarter of 2026, the number of waivers granted is exactly 0. Not reduced, not limited. 0. China has completely shut off silver exports to the rest of the world. Now you might be thinking, so what? We will just get silver from somewhere else. And that thought reveals exactly how little the average person understands about the global silver supply chain. China refines 40% of the world's silver. Nearly half of all the refined silver on the planet flows through Chinese facilities. And China has finally realized something that Western leaders are too arrogant to admit. Silver is not just a precious metal. Silver is the bottleneck of the entire green energy revolution. Every solar panel requires silver. Every electric vehicle uses silver in its electrical systems. Every wind turbine needs silver. And China is currently building 450 gigawatts of solar capacity to keep their own economy running. Why would they export the one resource they desperately need themselves to their economic competitors? The answer is they would not. Now they are not. This creates what I call the supply cliff. The vaults in London and New York have been quietly drained to historic lows over the past 2 years. They have been surviving on a lifeline of leased metal from Eastern refineries. That lifeline has now been cut. And the A-team returning to their desks today can see this in one of the most terrifying metrics in the precious metals market. On the Shanghai Gold Exchange, physical silver is trading at a premium of $8 to $14 over the New York paper price. In a normal functioning market, this gap would close instantly through arbitrage. Traders would buy the cheap paper silver in New York, convert it to physical, ship it to Shanghai, and pocket the difference. But that is not happening. The arbitrage mechanism has completely snapped. And it has snapped because the banks cannot actually source the physical 1,000-ounce bars needed to ship across the Pacific. That $75 silver price you see on your screen right now, that price is a museum exhibit. It is a relic of a price that no longer exists in the real world. The $83 to $89 price in Shanghai is the real price. That is what actual buyers are paying for actual metal that actually exists. But hold on, because what I am about to reveal next might be the most important piece of this entire puzzle, and it involves a betrayal so massive that it borders on financial warfare. Every month, the Commodity Futures Trading Commission releases what is called the Bank Participation Report. This document shows exactly how the biggest banks in America are positioned in the commodities markets. And the December 2025 report contains what I can only describe as a statistical impossibility. For 40 years, the big four U.S. banks have been the suppressors of the silver price. They have maintained massive short positions that act like a stone wall against any price increases. Every time silver tried to rally, these banks would dump paper contracts onto the market to crush the price back down. This is documented. This is proven. This has been the playbook for 4 decades. But the latest report shows that the U.S. banks have completely flipped. They have covered their short positions. They have gone net long. They are now positioned to make billions of dollars as silver explodes higher. Now remember what I said earlier. For every buyer, there must be a seller. If the U.S. banks closed their shorts and went long, someone else had to take the other side of that trade. And the report reveals exactly who that someone is. The U.S. banking giants have handed the entire poison position, a short of over 215 million ounces, to foreign banks in Europe and Canada. They have passed the death bag to their own supposed allies. The A-team returning today understands exactly what this means. JP Morgan and the other U.S. titans have weaponized the silver price against their own rivals. By flipping long, they have zero incentive to suppress the price anymore. In fact, they now want the price to explode. They want to trigger a margin call cascade that forces their European and Canadian competitors into bankruptcy. When a bank with a 215 million ounce short position is forced to buy back that metal in a market with zero available inventory, the chart does not just go up. The chart goes vertical. This is not trading. This is financial execution. And the U.S. banks are the ones with their finger on the trigger. Meanwhile, the industrial giants of the world are not waiting for the banks to finish their war. They are already making moves that bypass the entire financial system. Intelligence sources have confirmed that senior procurement executives from Samsung Electronics recently landed a private jet in Zacatecas, Mexico, the heart of global silver production. They are not placing orders through the COMEX. They are not working through the London bullion market. They are standing at the mine gates with an unlimited checkbook, trying to buy silver before it even leaves the ground. And the reason Samsung is this desperate involves a piece of technology that will completely reshape the automobile industry. Samsung's new solid-state battery enables a 9-minute charge time and a 600-mile range. This is the holy grail of electric vehicles, the technology that will make gas stations obsolete. But here's the catch that nobody is talking about. Each battery requires 1 kilogram of silver per vehicle. That is a 3,000% increase in silver demand compared to current electric vehicle batteries. Run the numbers with me. If just 20% of the global electric vehicle fleet adopts this solid-state technology, that single application will consume 192 million ounces of silver per year. That is 25% of the entire global mine supply, just for car batteries. Now add the solar industry, which has already shifted to N-type technology that requires 30% more silver per panel. Add the consumer electronics industry, add the medical device industry, add the water purification industry, and then add the one buyer that nobody can outbid, the Pentagon. Every Tomahawk cruise missile requires 15 kilograms of silver in its guidance systems. With military tensions escalating across multiple theaters, with signals intelligence suggesting imminent kinetic conflict in the Caribbean theater, the United States military has become an inelastic buyer. They will pay any price. They will outbid Samsung. They will outbid Tesla. They will outbid every solar manufacturer on the planet. Because national security does not have a budget. Constraint. The physical evidence of this panic is already visible if you know where to look. On December 23rd, the Asahi refining vault in New York saw 1.4 million ounces of registered silver vanish in a single day. Registered inventory is the for sale pile of the exchange. It is the only metal that can actually be delivered against a futures contract, and it is being rated by smart money taking physical delivery. Silver lease rates have spiked to 32%. Let me explain what that means. If you own physical silver and you loan it to someone for a year, they will pay you 32% interest. That is loan shark territory. That is desperation. And the market structure has entered something called super backwardation at 7.18%. In normal markets, future delivery is cheaper than immediate delivery because you avoid storage costs. But right now, buyers are willing to pay a 7% premium for silver delivered today instead of silver delivered next year. The market is screaming one message. I do not believe the metal will exist in 2027. Give it to me now. What we are witnessing is not a speculative bubble. This is not retail traders on social media pumping a meme asset. This is a fundamental repricing of the world's most undervalued strategic commodity. For 50 years, the paper exchanges in New York and London told the world what silver was worth. They set the price using contracts that were backed by nothing but promises. That authority has been revoked. The price is now being set on the loading docks of Shanghai and the mine gates of Mexico. The people with actual metal now decide the price. The algorithms that manage trillions of dollars of institutional capital have switched their programming. They have stopped fighting the trend. They are now chasing momentum into what traders call blue sky territory. This is price space, where there are no previous holders waiting to sell, no resistance levels, no ceiling. So, as the A-team sits down at their desks this morning, staring at screens full of red alerts and margin warnings, the question is not whether silver will hit $100. The question is how quickly it happens and what breaks along the way. If you are holding physical silver, you need to understand something. You're not just holding a metal. You are the bank. You are holding the only asset that cannot be created with a keystroke. The only asset that cannot be rehypothecated 10 times over. The only asset that the exchange cannot settle in cash when they invoke force majeure and admit they never had the metal in the first place. The A-team is late. The banks are trapped in their own betrayals. The industrial giants are desperate. The military is stockpiling. And the $17.2 billion emergency injection from last week was not a solution. It was a confession. Measure your wealth in ounces, not in the paper promises of a system that is bleeding to death. The era of true price discovery has arrived, and it is absolutely spectacular to witness. Stay stacked, stay smart. And whatever you do, do not blink, because the next 72 hours will separate those who prepared from those who trusted the wrong system.